Hello, everyone. Welcome to Wally Global. This is our W file. I'm your host. The Federal Reserve can be said to be the institution with the greatest influence on the financial market on this planet. Any problem with its policies led to the most serious global economic depression in the 20th century. It brought about a major trend in the US stock market for more than 10 years. A little lax supervision led to multiple financial tsunamis. The decisions made by these 12 people in meetings can affect the global economy. Such an important institution actually has shareholders and pays dividends every year. Most of the bankers, iBankers, and financial practitioners, also those who are working in the Wall Street Bee, a large part of time is paying attention to the decisions of the Federal Reserve and what those old professors were thinking. Today, we will not only talk about the Federal Reserve, but I also want to use the US central bank illustrate the operating mechanism of the central bank, some of the trade-offs it makes when formulating monetary policy, and some small thoughts about the Federal Reserve in the country. The full name of the Federal Reserve is the Federal Reserve System, abbreviated as Fed. Please note that there is no S in Fed. If you add S, Fed becomes FBI slang. Just don't get confused. The Federal Reserve is the central bank of the United States and is in charge of the US monetary policy, including printing money and formulating short-term interest rate policies, etc. If you look closely, there will be a big Federal Reserve note written on the US dollar bill. The Federal Reserve Exchange Certificate is money. Now, you may think that a central bank is something that every country has. It is a very common standard for government departments. But I tell you that this is not the case with the United States. From its founding in 1776 to the present, for about 250 years, for more than half of the time, it has not had a central bank. This is because Americans, from the bottom of their hearts, do not believe in the central government, do not believe in centralized power, and do not even want to build a central bank for printing money. There were indeed two times when everyone had to go to war and had no money. So they jointly created a temporary central bank, namely the First Bank of the United States and the Second Bank of the United States. These two so-called central banks were established to help the states tide over the difficulties, and then they were closed down 20 years later. You may wonder if there was no central bank. You might not believe it. In the 19th century, many private banks could issue their own bills, which were basically equivalent to money. The United States at that time focused on free competition. You see, it was already free to this extent. Of course, this does not mean that you can just take a small piece of green paper and draw a small paper with 100. It is definitely not the case that you can just take it out and spend it. Anyone can print money, but for the money to be truly circulated, you must have collateral, such as gold, silver, or US federal government bonds. Later, at the end of the 19th century, banks experienced several systemic crises in succession. As soon as people heard the pumps moved, they immediately rushed to the bank to exchange money. The most serious crisis was in 1907, when the US government had to ask private banker J.P. Morgan to step in and use his personal prestige and funds to help the market overcome the difficulties. After all this trouble, everyone finally realized that free competition was too terrible. We still have to have a central bank. At least when these commercial banks are run, there must be a central bank to fight. So the federal government began to draft the Federal Reserve Act and officially established the Federal Reserve in 1913. The institutional design of the Federal Reserve is actually very sophisticated. You said that the reason why the United States has never had a central bank is because the people do not trust the central government and are unwilling to let the government have the final say. But if you want to create an institution that is completely out of the control of the government will definitely not be happy. So when discussing the operating mechanism of the Federal Reserve, the government and these private bankers went through a fierce game of bargaining and tearing for 3 or 4 years before they found a balance point that everyone can accept relatively. Let's see how they solved it. You hear the full name of the Federal Reserve. It is called the Federal Reserve System, not the Federal Reserve Bank. So it is not a bank, but a system composed of 12 regional reserve banks. These 12 reserve banks have their own jurisdictions and are responsible for managing all the commercial banks in this area. Each reserve bank is controlled by thousands of member banks in this region. In other words, the Federal Reserve is actually an institution controlled by private banks. You may have some doubts when you hear this. We will explain it in detail later. These regional banks do have some autonomy in administrative affairs, but when it comes to some key monetary decisions, such as false interest rates and printing money, there is still a centralized decision-making layer in the central government called the Federal Open Market Committee, which is FOMC. Pay attention to this FOMC. Although it is just 4 words, it is very, very important. There are 12 people in total. These 12 RHUTs are the organization that truly formulates all important monetary policies of the United States. They are also the core of the Fed's decision-making vortex. You can imagine that 60% of the world's foreign exchange reserves are in US dollars, and the amount of US dollars issued and the interest rate are all decided by these 12 people in meetings. Maybe a few people are discussing while eating lunch. If we don't raise interest rates, hundreds of billions of funds in the world will be immediately withdrawn. The United States is so powerful. Among these 12 people, 7 are called executive committee members of the Board of Governors. One of them is the chairman of the Federal Reserve, currently Bob Bill. This position of chairman is for a 4-year term and he can be re-elected. The term of office of the other 6 members is 14 years. These 7 executive members, including the chairman, are all appointed by the president and can take office directly after being approved by the Senate. The remaining 5 seats among the 12 are rotated by the chairman of the regional Federal Reserve banks. Everyone can take turns every year. Among these 5 seats, the New York Federal Reserve is too important. So the chairman of the New York Federal Reserve has occupied 1 seat all year round. The remaining 4 seats are rotated by the remaining 11 regional Federal Reserve banks. This is roughly what it means. This forms the 12-member super team of FOMC. These 12 people have to get together for 8 meetings every year. That is, they have to hold a meeting every 1 or 2 months, which is what we often call the Fed meeting. What they discuss is the most important monetary policy. After the meeting, they will issue a meeting record called a statement. For example, whether the Federal Reserve will raise interest rates and how many basis points to raise are all announced after the meeting. This is also the absolute focus of the global financial market at that time, because the FOMC is so important. We would list the styles of each of the 12 people and pay attention to their remarks. Generally speaking, we usually divide these people into doves and hawks. If you don't know what's going on, doves will be dovish and relax, lower interest rates, stimulate, and make some money. Hawks, on the contrary, will reduce. For example, the previous chairman Bernanke was a typical dove, and Yellen was also dovish. The current Bobil is relatively neutral. Aren't there 4 of the 12 people who rotate among the regional Federal Reserve chairmen? So you not only have to pay attention to the styles of the current 4 people, but also the styles of the next 4 people who are about to come up. I remember it very clearly. There was a guy named Cash Carey at that time. In 2016, he became the chairman of the regional Federal Reserve. He was a super dove. As soon as he was elected as the chairman of the FOMC, each of the 12 regional reserve banks had 9 board members, 6 of whom were nominated by the local commercial banks, and 3 were nominated by the executive committee members, who were considered government officials. Don't worry, everyone. After I finish, I will talk about a very important feature of the Federal Reserve, so bear with me for now. This whole executive committee, FOMC, the regional Fed, and the member banks form a simplified framework of the Federal Reserve. What is the core idea of this framework? It is the checks and balances between the government and private banks. Each level of the board of directors here has both bank personnel and government personnel. The bottom level is all commercial banks holding the centralized decision-making FOMC, and most of the executive members are appointed by the government. But later, gradually, although the 7 executive members of the FOMC are selected by the government and have a government background, the government may not be able to control them. Because once appointed, it is actually very difficult for the government to remove them. It requires more than 2/3 of the votes of Congress. For example, at the end of 2018, it was a period of interest rate hikes. The government certainly does not like interest rate hikes. Interest rate hikes will suppress the economy, which will be disadvantageous to the votes. We must know that at that time, the Federal Reserve Chairman Powell was appointed by Trump himself. As a result, Trump turned around and started to scold, saying that I think the problems of the Federal Reserve are more serious for the United States than for China. They have made a huge mistake because I have a hunch. My hunch tells me more than anyone else's brain. Of course, it's good to give Trump a discount for what he says, but you can more or less feel that, at least on the surface, the US government's control over the Federal Reserve is actually very weak. Even if the president personally promotes someone, he may not necessarily do what he wants. Powell himself said in an interview, so what is the purpose of setting up such a complex operating mechanism? It is to ensure the independence of the Federal Reserve and the fairness of its decision making, because the market knows, the Federal Reserve knows, and the US government knows the cornerstone of the Federal Reserve is actually trust. Because the power in its hands is great, but this is based on the market's trust in you. The more the global market trusts you, the more people will use your currency and the greater your influence will be. This is a positive incentive, and the Federal Reserve's neutrality mechanism is to maintain this trust. It does not mean that I will do whatever the US government tells me to do. The long-term benefits brought are far greater than the small short-term benefits brought to the government by several monetary policies. Let me tell you a little historical story here. In fact, right after the end of World War II, the global market did not have much trust in the Federal Reserve. But in 1979, a chairman of the Federal Reserve named Paul Walker won the heart of the market. He can be said to be a legendary figure among the Federal Reserve chairmen. His tenure was actually quite unlucky. He experienced 2 oil crises. At that time, inflation in the United States was high. In order to suppress inflation, he directly raised the interest rate to more than 20%, under the pressure of the whole society. Raising interest rates can certainly curb inflation, but it will also curb economic vitality. The unemployment rate in the United States at that time even exceeded 10%. Not only did the government politicians express dissatisfaction with Paul Walker's extreme policy, but even the public would offer him death threats. The government had to send the Secret Service to protect his safety. As a result, after the United States experienced a brief period of pain, inflation was really suppressed, which opened up the rapid development of the US economy for 20 years. After the epidemic, Walker also won the first battle to prove to the world market that the Federal Reserve can stabilize the dollar. The Federal Reserve will not be manipulated by American politicians so that everyone can hold the dollar with peace of mind. It smoothly helped the United States transition from the era of the gold standard to the era of floating exchange rates. In fact, it is the era when the dollar is king, and the Federal Reserve naturally became the most powerful institution in the global financial system. Anyway, because it is linked to the global capital market, the Federal Reserve's every move is the focus of global attention. Let's talk about the Federal Reserve. Just now, we talked about the structure of the Federal Reserve and the independence of its decision making. Some thoughtful friends may have doubts. Didn't we say that the Federal Reserve is jointly held by all member banks? Then you should consider the maximization of shareholders' interests. How can you say it is independent? Let's talk about the shareholding system here. First of all, the Federal Reserve does give returns to these commercial bank shareholders, and the rate of return is very impressive, up to 6%. But in fact, although this 6% sounds good, the shareholders have very little equity capital. In 2022, it only distributed a total of 1.2 billion US dollars to all commercial banks in the United States. The attribute of private shareholding now has far more symbolic significance than actual effect. Moreover, the Fed's stock is completely non-circulating, so it is a bit like a member deposit for a commercial bank to join the association. Each commercial bank will not rely on the Fed to make money, and the Fed will not serve the interests of shareholders. So some people say that the Fed is a private enterprise, which is legally okay. There is a joke, but you certainly can't understand it as a private enterprise in essence. But let me tell you, although it doesn't distribute so much money to shareholders, the Federal Reserve is actually very profitable. And do you know who this money is given to? The US government. In fact, many people don't realize this. First of all, we have to know how the Federal Reserve makes its profits. You can't say that this money is printed by me and it counts as my profit. This is definitely not possible. The money it prints is actually equivalent to a zero interest loan. I can use this money to lend it out or use this money to buy various investment products. The interest after the loan or the return brought by the investment products can be recorded under my revenue. All these profits, except for those symbolic dividends, will be handed over to the US Treasury. I also specifically calculated its data for the past 10 years based on its financial report. On average, the Federal Reserve contributes 90 billion US dollars to the US Treasury every year. Didn't it raise interest rates recently? Because most of its hands are some mutual bonds, which have fallen. So, in the past 2 years, it made very little money. Only 59 billion US dollars were handed over. The Fed gave away its profits. In fact, this behavior can ensure the fairness of its decision making. That is, its monetary policy will not be affected by how much I make, and the government will be happy. Although in theory the Fed is completely independent of the government, you can rely on such a department to collect less than 100 billion every year, right? You see, it is actually a lot of money for the US government. And I tell you, just combine the two easing measures of the Fed. No matter what the interest rate is, the US government has borrowed debts. Part of it is bought by the Fed printing money. After that, the Fed's income is returned to the Treasury Department. You see, this is equivalent to the US government after going around in circles. Well, what we just said is very exciting, but we are actually mainly talking about the independence of the Fed. As an independent central bank, what is the goal of the Fed, and what weapons does it have to achieve this goal? First of all, its goal is very simple, and the most important goals are stable prices and maximum employment. However, these two goals often conflict. If you want to stimulate employment, you may need an easy monetary policy, which will lead to inflation and rising prices. For example, in order to curb inflation, Walker raised interest rates, which led to an increase in unemployment. How to balance the two is something that the Federal Reserve needs to figure out. Of course, general economics now believes that price stability is more important. We have analyzed this in detail in the inflation issue. What monetary policies does the Federal Reserve have? In fact, Its arsenal was very rich in the early days, such as interest rates, loans, and control of various areas. But as the market matured a little bit, its arsenal began to simplify. It mainly controls one thing, which is the interest rate, that is, the interest rate between banks. We usually say that the Federal Reserve raises and lowers interest rates, which actually refers to this interest rate. We won't go into details about how it adjusts the interest rate for a day. You see, it actually has some tools. In the final analysis, they are all controlling the federal funds rate for a day that we just talked about. This short-term interest rate actually determines the money in the market. The circulation speed actually controls the amount of money in the market. All other interest rates, such as your deposit interest rate, mortgage interest rate, treasury bond interest rate, etc., are all determined by market supply and demand. The Federal Reserve cannot directly control it. Of course, although it cannot directly control it, in fact, all those interest rates are highly correlated with the federal funds rate of the day that the Federal Reserve can control. We have talked about this in detail in the interest rate issue. The Federal Reserve System evolved to the 1990s when Greenspan was the chairman of the Federal Reserve. It can be said that it was invincible and successfully withstood the impact of several stock market crashes and the Asian financial crisis. The market felt that it was very close to perfection. It's like what? It's like in the 19th century when physics felt that it had understood the true meaning of the universe, except for the extreme left-wing dark clouds. There was nothing it didn't know. Who knew that quantum mechanics and relativity in the 20th century opened the Pandora's box of physics, and the Pandora's box of central banks was opened a century later in the 21st century? In 2008, Lehman Brothers collapsed and the financial tsunami swept the world. In order to stimulate the economy, the Federal Reserve raised the interest rate from 5.25 to 5.5. It quickly reached the lowest level in half a century, almost zero. However, facing the once-in-a-century turmoil, interest rate cuts alone were not enough. Market confidence was still almost at a freezing point, so the Fed started the next upgrade. It remembered the quantitative easing operation of the Bank of Japan a few years ago, which was QE. I could not only control the short-term interest rate, but also print money to buy long-term bonds in the market. This would lower the long-term interest rate. Wouldn't the whole society be able to finance at a lower cost? This move was actually very risky. The Fed didn't know what the result would be after implementing quantitative easing, because in fact, Japan had only done it twice on a small scale, and no one else had done it again. Afterwards, the members of the FOMC admitted that this was actually an experiment that gambled on the US economy, but there was no way to prevent the US from falling into a similar depression 80 years ago. Fed Chairman Ben Bernanke decided to try quantitative easing. He wanted to put 1.75 trillion bonds, which is equivalent to a quarter of all the bonds in circulation on the market, were all bought up in more than a year. As soon as this move was made, the market was immediately shaken. The interest rate of 10-year Treasury bonds fell by more than 100 levels in 2 days. Due to the decline in interest rates, the investment return rate of bonds fell, and a large amount of funds poured into assets with higher returns, mainly the stock market. Stocks soared during the QE period. The financial market was cheering, and the surge in asset prices did drive the real economy through the wealth effect. The wealth effect is that when stocks rise, everyone feels that their wealth has increased, which will increase consumption and total demand, thereby driving the confidence of the entire society. In fact, the rise in real estate in China in recent years has also stimulated the development of China's economy to a great extent through the wealth effect. The unemployment rate in the United States finally stopped its upward momentum and began to decline steadily. The Federal Reserve saw that this move was quite effective, and then the second and third waves of QE came. The effect was good after 3 rounds, so that the United States did not fall into recession. It seemed that the Federal Reserve had successfully resolved the crisis again, but just when it was about to slowly introduce these temporary policies, problems arose and the market appeared. In May 2013, Federal Reserve Chairman Ben Bernanke publicly said that he was considering reducing quantitative easing, which is taper. Please note that this does not mean that you should start selling the bonds you have. It only means that you should buy less and sell more. Furthermore, the market started to panic before the considerations started to decrease. The bond market panicked, and the interest rate on 10-year Treasury bonds rose by more than 100 levels in half a year. Seeing such a fierce reaction from the market, Bernanke immediately came out to smooth things over and said, "I'm sorry, I won't lock it anymore. Just treat what I said before as a fart." This eased the tense market sentiment. This farce is the famous taper tantrum, the balance sheet reduction panic event. What it means is that the Federal Reserve used QE, a strong medicine, to make the market recover quickly, and the market felt too comfortable and satisfied and developed drug dependence. As a result, now that the Federal Reserve wants to reduce the amount, the market immediately started to throw a tantrum. I tell you, this wave of QE by the Federal Reserve, its biggest effect is not to stimulate the real economy, but to create a wave of stock market myths. Note that this is a humorous irony. This is actually a very embarrassing point when the Federal Reserve adopts monetary policy. When the economy is in recession, no matter if I lower interest rates, print money, and buy bonds, these financial institutions are actually unwilling to lend out the income money, but invest, by the way, in the United States. It mainly buys stocks. The normal interest rate of listed companies has dropped, so it can raise funds at low cost, but it is actually more inclined to buy back its own stocks. To put it bluntly, it is still buying stocks. So, looking at it from the inside out, no matter what monetary policy the Federal Reserve uses, most of the capital will eventually flow into the stock market. Although the Federal Reserve's goal is to stabilize prices and reduce unemployment, you have never heard of letting the stock market rise. But the result is that the Federal Reserve stimulates the stock market is soaring. This is not just the case with the Federal Reserve. In fact, central banks around the world are facing similar problems. They can only decide how much money to print and how much to spend, but they can't actually decide where to spend the money. It's like the Federal Reserve controls an irrigation system. You might want it to use the water to irrigate, say, a rice farm, but all it can do is open the valve upstream and release the water. It really has no way to control where the water flows. Maybe a small part of it flows to the rice farm, which is the real economy, but in fact, most of the water flows to the reservoir nearby. This reservoir maybe the stock market, real estate, or overseas assets. So we always said that the most important thing to look at when investing in stocks is the financial report, not the Federal Reserve. There is a classic saying on Wall Street called, "Don't fight the Fed." Don't fight the Fed. The Fed has become the god of wealth in the stock market. Although the Fed is very independent, Wall Street will still put pressure on the Fed in various ways. You can't stop QE and you can't stop taking this medicine. This will help the US economy. Just when the Fed has finally calmed down the market, is our easing a bit too much, and started to raise interest rates and shrink the balance sheet. The epidemic came and the familiar process started again. Interest rates returned to zero and quantitative easing was carried out. It's just that the Fed has really tipped the cart out this time. The last time Bernanke wanted to do this, he studied it for several months. This time, Powell got it done in one weekend. And this time, it is the largest trend in human history. Not only buying Treasury bonds, not only buying MBS, Even corporate bonds are bought. In an era when everyone is staying at home and the economy is almost at a standstill, the stock market has ushered in another wave of carnival. Do you think it is efficient or not? Just 1 year later, due to the massive quantitative easing of the Federal Reserve and the US government's 5 trillion fiscal stimulus, the ultimate demon that the Federal Reserve fears the most has finally begun to awaken. Inflation is injected with water and medicine, but once this monster awakens, there is nothing to say. The fake interest rate has increased by more than 500 basis points within a year. You must know that most of the world's currencies and most of the economies are all pegged to the US dollar, which has directly triggered large scale economic turmoil in the world. Not only will global assets plummet in 2022, but the United States itself will also usher in the second, third, and fourth largest bank failures in history in just 2 months in 2023. The Federal Reserve is inseparable from this turmoil in the banking industry, and it is also brewing another upgrade. What are the side effects of the United States' more than a decade of excessive easing followed by convulsive tightening, and what potential crises are there? We don't know yet. It is known that, in fact, if you look at the Fed's policies over the past 30 years, you will have a feeling that when the economy is booming, the Fed will be too relaxed. When the market collapses, the Fed will have to come out to rescue the market in order to ensure market stability. This is actually not the Fed's original intention. What it hoped for at the beginning was to maximize the efficiency of free market competition. But if something goes wrong, I will come out to rescue it. But what will happen over time? Wall Street is good. You can play around with the collapse anyway. The Fed will cover the bottom line. It has rescued the market time and time again, and it has even cultivated this feeling in Wall Street, creating an instinctive reaction. In fact, to go deeper, I think it is not only Wall Street and the Federal Reserve that have this contradiction, but this problem exists at every level of the financial system. This game mechanism allows players to have a bottom line option. If a financial company collapses, the Federal Reserve and the US government will cover it. If an ordinary company collapses, the worst that can happen is bankruptcy, which can also be covered. For example, a fund manager can lose money even if he loses a lot. The worst that can happen if he loses is that he will be fired and his own money will not be affected. Once he makes money, then it is all his without any cap. You see, finance itself is actually a leverage game, a trade-off between risk and return. However, because of the bottom line game mechanism, the risk and return are actually unequal. It's like, for example, you play a coin tossing game, you win money if it's heads, and you lose money if it's tails. This is fair and reasonable, right? But now, what if I tell you that you still win money if it's heads and lose money if it's tails, but there is a cap on your losses, and you can only lose 1 million at most? This is the upper limit of the penalty. So, what do you think is your profit maximization strategy at this time? You just bet as much as possible. For example, if I bet 100 million, then if I win, I get 100 million. And if I lose, the worst that can happen is I lose 1 million. In this way, my expected return will suddenly change from 0 to nearly 50 million. So you see, the game rule of capping losses will encourage all players in the market to engage in higher risk activities. The higher the risk of an activity you engage in, the higher the expected return. In fact, fund managers, listed companies, and Wall Street banks in the financial market are all very clear about the rules of the game. If you think about it carefully, it's not just the financial industry, but many economic activities in the entire market also follow this principle. The Federal Reserve certainly doesn't want to encourage these financial institutions just because it can provide a guarantee. So it gradually realized that ex ante supervision is more important than ex post rescue. So, after the financial crisis in 2008, it greatly increased its supervision, but this strength apparently did not seem to be enough. That the Federal Reserve has begun to plan how to upgrade the next round of supervision. In fact, there is one more thing I want to talk about the Federal Reserve. I think one of the things it does very well is that it maintains full transparency in communication with the market. In fact, any market practitioner should be deeply touched by this, and it also makes everyone have a lot more respect for the Federal Reserve. He will tell you in detail what he thinks and the basis behind each decision. It even includes how these 12 people specifically voted and what these 12 people specifically think. This is very useful. It is called dot plot. After each FOMC meeting, this dot plot will be released to tell you what each of these 12 people thinks the future interest rate will be like. It will all be released to you. This dot plot is sometimes even more important than the interest rate policy. For example, if you want to raise interest rates by 25 basis points or 50 basis points, the market has already predicted a large amount, and it is not far from reality. However, what is the expectation of each member of the FOMC for the future? This fluctuation is relatively large, so it will also become a core of market attention. In fact, the Federal Reserve has really released a lot of economic research materials on their website. Although the website design is a bit ugly, it does hide a lot of treasures such as economic data, their theoretical research, popular science, and even papers, etc. There is a relatively famous book in the industry called Beige Book. Literally translated, it's called a beige book. Aren't they generally called white papers in China? Maybe the Federal Reserve prefers beige. This book is updated every once in a while and includes some economic research done by 12 local feds, as well as local economic conditions. It should be a must-read for practitioners. Although you feel that the Fed's final decision may be extremely simple, that is, to raise interest rates or not, and to raise interest rates by a certain number of basis points, you may feel that this may be the simplest job in the world, but they use various research reports and even speeches to tell you that they have made careful decisions before deciding how big the faucet should be open this time. They are not just turning it randomly to scare people. In the final analysis, it's still in order to increase the market's trust in it, in addition to explaining the mechanism, history, and goals of the Federal Reserve. I also delved into some of its problems and the underlying game logic. In fact, central banks of various countries also follow a logic similar to that of the Federal Reserve. To be honest, this video may not be so easy to understand, but I think it will definitely be very helpful for everyone to understand the macro economy, macro policies, including the central bank's decision making. Thank you for watching. Hope you like this W file. Please be invited to subscribe my channel and see you next time.